All right. So again, my name is Jeff Clark. I'm a regional director here with GoldenCare. Have been with GoldenCare for 20, nearly, well, I guess 25 years this month. So been here a while. I've spent a lot of time selling. Cut my teeth kind of on long-term care sales. I've written about 750 long-term care policies, I suppose, somewhere in there. I also do some Medicare work, but my job mainly now is to, recruit and train. And basically, I break down, look at policies, look at products, try to help our agents with kind of design the right plan, the right company, the right product. And so I do a lot of time, I guess, dissecting and looking at products at the higher level. So the premise behind this webinar is, about a year ago, Mutual Omaha did what they like to call a rate refresh. So, which is a nice way of saying they increased the prices on some stuff. Essentially what they did, I'm going to show you this, is they increased the prices on the inflations, the 3% compound. Married couples lost some of their discount. They took away instead of being a 30% discount for married couple, it dropped down to like 15. So married couples saw a little more expense, the 3% compound. So what we had to do is we kind of had to rethink about how we're going to quote, how we're going to design a plan. So that was the kind of premise behind this webinar, is to help keep those long-term care premiums affordable. So with that, we'll go ahead and get started here. And I'm being told that we can go ahead and get rolling when everything's ready to go. So let's see here. All right. Mutual of Omaha premium rates. So this is kind of what I already mentioned. Again, we did this webinar for the first time about a year ago when the rate rollouts first happened a year ago here. At this point, the reason we're doing it because they've completed all 50 states now with the exception of California. So here I think you're saying 32 states are adding more in that 19th. Well, we're now at the point where we've got every state done, I believe, except for California and maybe New York. Don't quote me exactly on that, but I know California for sure isn't. So like 49 or 50 states now have all had this increase. So it's kind of a good time to bring it up again. So the mutual advantages, there's still first day cash. There's a 25% home health care benefit instead of 40% cash. And I can tell you, part of what I do to readjust these premiums, I go higher monthly amounts to begin with, lower inflation. So essentially, if I go with a $7,000 a month benefit versus a $5,000 a month benefit, then 25% of the 7,000 is going to kind of net out that loss. So what I'm going to teach you today is that we're going to go with higher amounts and smaller inflation. But so anyway, some of the other things they did, they went with a 25% cash benefit. We still have great unparalleled flexibility on the different inflation things we can do. I'll show you this. We have those quarter point increments of inflation, 1%, all the way up through 5. Mutual Omaha is still the number one carrier in long-term care. I mean, Mutual Omaha is still the cat's meow out there. I mean, I guess the slide's telling you is that, as far as if I have clients that are healthy, can afford it, can pass underwriting, this is the first product I look at. It's just the best product going. Now, if we have people that are looking for, a joint policy, or maybe they want a 10 pay, that's why GoldenCare carries all the carriers. We have good carriers like the NGLs and the Thrivents and the home health care only and the critical cash. So depending on whether you have an unhealthy couple or someone a single or someone who's looking for a 10 pay, or no matter what you're looking for, GoldenCare has the products for you. But Mutual of Omaha is still our kind of our clear standout as far as the first place you look on long-term care. Okay. Concerns with raising premiums. What to do? Well, I've done a long intro explaining exactly what we're talking about here. And yes, we're going to crack the code and kind of try to teach you how to design quality plans that have meaningful benefits while trying to keep those premiums down. Okay, so today's agenda, we're going to review the short and fat plan. If you haven't heard me speak before, I've done this concept for 10, 15 years teaching agents, how to shorter, fatter is better than a long, skinny. I'll go over that. We'll review that. We're going to revisit that short and fat, and we're going to give you what's called short and fat 2.0. And that's kind of the crack the code right there. Where to start, we'll give you kind of an area of, again, if you're just sitting down and you're newer to it, and I don't want to, these rates are so hard to, even forget the crack the code of the new rates. This is more or less just how to keep, premiums affordable for people and still have some meaningful benefits. So call this, now that we're a year removed from the rate changes, this is really a webinar about how to design quality benefit packages without killing them in premium. So let's call it that. So this is my short and fat. This is my original thought that I used to teach agents. You know, you never want to use, and I guess I'm going to say never. I have a tendency to be a little bit more dramatic with some of these things, but 5% compounds, the incorrect way to sell long-term care, has been for a long, long time. It's all we had back when I started 20 years ago. But, you know, 5% compound is just a very, very unnecessary, and really you should almost never use it. Unless you're selling 35 to 45-year-olds, it's really hard to sell 5% compound, okay? The carriers, if you'll notice, if you want to go history of long-term care, you know, the 5% compound got the long-term care carriers into trouble because that 5% can grow pretty fast, and you have 40, 50-year-olds that bought long-term care and they don't go and claim for 40 years. Well, those things have doubled, tripled. So you have pots of money that are well over $1 million. And so the companies really attacked 5%. This is going back 10 years ago. When they adjusted rates back then, they really attacked the 5% compound. So we kind of taught people, stop selling 5%, go with a higher daily amount and use 3%. So the example I'm showing you here on this slide, important that you follow this, and there's actually one more slide after this that I want to tie all together. So here, the old school way, we used to sell like $150 a day, $4,500 a month, 5-year benefit, 5% compound, 100% assisted living. So, you know, if you take 5-year plan and you take $4,500 a month benefit, you know, these policies are always just a pot of money. Well, if I take 5 years at 4,500, that pot of money is $270,000 maximum. If I do with 5% compound, okay, my annual premium this way, $11,488. Look over here to the right. Now here what I did is I still use a pot of money of $270,000, but I structured differently. I increased that from 4,500 up to 7,500 and dropped the inflation down to 3. Move the assisted living at 50%. So essentially designed the same plan, same policy maximum, but I dropped premium here. I dropped about 30%, 40% of premium. So now look at the benefits, because naturally 5% grows faster than 3%, and we all can understand that. So in other words, right off the get-go, okay, this is a 60-year-old couple, by the way, age 60. So average claim happens at 83, 84, well, 84 or 85 for females, 82 for men. So, let's just figure on 20, 30 years from now, what do the benefits look like? Well, by starting out at a higher amount, 7,500, I'm really ahead. So eventually that 5% is going to catch it. Well, so year 10, I'm at 7,000 here on the 5%. Over here, I'm at 10. Year 20, I'm at 11,900. Here, I'm at 13,500. So in 30 years, somewhere around the 27th year is when this kind of catches each other, 28th year. So they're going to be beyond their claim. So I do think it's a better design. Typically, when people do live to 90, 95, if they go on claim, those claim lengths are very short, naturally because they're 95, 97 years old. So I'm a big believer in shorter and fatter. And so I think they have a next slide that's going to illustrate this. So what I've done then is I changed that 3%. I changed the 3% compound. So this was all I did. From this one, we went and changed from a 3-year benefit, a 5-year to a 3-year, a 5% to a 3%. Okay, naturally that's $7,500. It's still a $270,000 pot of money. So let me take it one step further. Okay, now we're gonna do the same thing. As a matter of fact, let's hit this point so I can show you what I'm talking about. So 11,488. So let's look at the software here. If you don't have the software, it's some of the easiest to work in the industry. If you can get this at mutualltcquote.com. If you don't have it, download it, play around with it. It's the easiest software. It's the best software in the long-term care industry. All products, all things. Mutualltcquote.com is how you get that. Okay, so I've got the example I have on my screen here. $4,500 a month, which works out to 5 years, $270,000 pot of money, 100% assisted living, 5% compound. That premium is $11,488 for two 60-year-olds. Select rates. So remember, if I want to go short and fat, I'm going to go ahead then. I'm going to take this down. I'm going to go 3%. I'm going to put this up to 7,500. I'm going to lower the assisted living back. Pot of money is $270,000 still. Okay. There's my new premium, 8601, which I think that matches up. All right. So now, for the crack the code, and this is for anyone designing plans now going forward. And again, we're going to show you some more examples here, but this is the nuts and bolts of it right here. This is short and fat 2.0. We've had to even go shorter and fatter and less inflation to kind of compensate for these, because what they did this time around, Back, 15 years ago, they attacked the 5% compound. The carriers did, a lot of carriers did, not just Mutual of Omaha. Well, now they realize that as an industry, and you can call GoldenCare responsible for this because we used to write, I don't know, 50% or 60% of Mutual's long-term care. So a lot of it comes from us, and we taught people how to do this. Don't do 5% quantity, do 3%. So I think Mutual finally figured out that we got to adjust that 3%. So they increased the 3% compound inflation like 20, 30%. So now I'm teaching people to go to 1%. All right. So at 1% here, watch this. So we're going to go ahead and we're going to take the benefit maximum all the way up to $10,000. We're going to go 1% compound, 50%. We're going to still keep the pot of money at $270,000. So all three of these designs, they have a pot of money of $270,000. Okay. So let's do that. Let's go all the way up to 10,000. I wish you'd go higher, but we can't. It's as high as we can go. Still 270. We're going to put this at 1%. Okay. Now they're going to tell us it's not partnership. Big deal. I won't go into it now in this webinar, but if we want to talk about the merits of partnership, your clients have a better chance of winning the lottery than actually accessing partnership benefits. And I'll explain it to you another time if you want to call me afterwards. Or it's pretty few and far between that people actually access the partnership plan once they wipe out their insurance policies, then go and wipe out all their assets. And then this is like 16, 18 years of care or something. And then at that point, if they still have, $500,000, are they going to want to go to a welfare nursing home when they can stay at home and use their own money? I don't think they're going to want to make that move if they even get to that. And less than 1% of people will actually be eligible to do it. And less than 10% of them will actually even use it at that point. So it's 1 in 200. Not quite lottery was, but so I don't care if it's partnership qualified anymore. It doesn't mean anything to me anymore, and it shouldn't really to most of you either. Okay, so 50%, $10,000, $270,000 pot of money. Now my premium's 58. So for those of you that are designing plans like this, long, skinny, using 5%, maybe you're someone who writes one long-term care plan a year. Maybe you're a financial planner that that just doesn't do much with this. I'm not trying to upset you or shame you or any means. We don't use 5% compound anymore. I mean, if people are using 5%, it usually just means they don't know any better. And so I can tell you, look at this here. I've cut this premium in half from what it was, 58 instead of 11.4. And look at the benefits. 10 years from now, I start at 10,000. I'm still way above this plan. 20 years from now, I'm still above it. So there's a 6-year-old couple. Average claims around 81. So this crossover might be somewhere around 80, 82, 83. But let me tell you another thought. And I know we're kind of hitting a lot here, and I've got more slides to do. But I do believe that when you're selling long-term care, the need for long-term care is much, much stronger when someone is 66 years old than when they're 86. Why? Because a 66-year-old couple, they just retired. They're planning on living on their nest egg for 20 years, right? The last thing they want to do is at age 67, husband has a stroke, they get wiped out $500,000, they're in their nest egg. So after you've lived for 20, 25 years, so the argument that these benefits might cross over at some point when they're 86 or 90, well, at that point, they've lived their retirement. The need to protect that retirement money has diminished because most of it's gone at this point. Now they're down to just probably income. They've went through a lot of their assets. And so, I'm not worried about the crossover point that somewhere at age 97, the short and fat thing doesn't work out as good. We're trying to protect them. And by the way, when someone has a stroke at 67 and goes to a nursing home, is $4,500 a month going to cover any nursing home anywhere? Of course not. So you're paying double the premium. And when you go on claim early on, you're going to be shorted $4,000 a month on top of being double charged in premium. So at least over here, I'm at 10,000 should take care of most of that bill in case something happens at age 67. So I like giving them more insurance up front and more insurance over the next 20, 25 years as a trade-off to have a little less insurance for ages 86, 87, 88, 89. Who cares, right? It's more important early on. So that's why this whole thing, and call it my humble opinion here, and I'll stand by this, short and fat, lower inflation or no inflation is the way to go. Okay, so with all of that, let me show you what we're doing here. So I'm going to show you a couple examples. And again, I don't really have a long webinar here. So I know for those of you who are looking forward to a full hour here, I've probably got 15 more minutes or so on this. I do encourage you that if you have a case you're working on, something you're quoting, don't try to suck all this webinar knowledge up and try to go ahead and call us, call the marketing office. I'll give you the 800 number here at the end. And, just tell us what you're working on. I got a 63-year-old couple, 63 and 61. They're in decent health. Let us help kind of design this for you. So in this particular example, there's 3 areas I wanted to look at to kind of show you about this shorter, fatter, or this cracking the code. So if you'll notice here, single female is what I used here. This is these bright columns here on the right. This is how much the policy actually went up with this new rate refresh. So if I look at a single 60-year-old female, the old rates were 48.52, the new rate's 58. So that was a 19.6% increase. Where it really hurt is if I look at a 60-year-old couple here. Okay, then I ran a benefit thing of what, 4,500, 6-year plan, 3% compound, select, standard rating. Okay, so here the premium was for the 60-year-old couple 59. Now it's 85. Pretty significant, right? So it's a 43% jump. Here's a 55-year-old couple. This again, that 3% compound that they didn't really affect the 1%. That didn't really change much at all. The 2%, and of course the no inflation didn't change at all. Those rates didn't change. So, but with this 55-year-old couple, it was 33.91. That went to 49.69, so that's a 46% increase. So we had brokers call us saying, "Oh, the rates went up 50%." Well, they did if you hit those strong spots. We don't want you to use 3% anymore. We don't want you to use some of the things. You have to be more creative. So with that, I'm going to show you these 3, how I would design these 3 to kind of get out of that. Okay. So this one here, this again was for a single female age 60. Remember, that was 19% higher. So how would I get rid of that 19%? So first of all, this is how the long skinny design, 5-year plan, 4,500 benefit using 3% compound. Old rate, 48.52. With these with the rate increases, 58.08, right? About a 20% increase. Again, just looking at this, it was 19.6. Okay, so that's where. So this, if I took the rate increase as it was, and I designed plans the same way, I'm looking at 20% higher. But if you do the sure, so here, instead of doing a 5-year benefit and 100% assisted living and 3% compound, and the policy maximum is 270, I'm actually going to increase that policy maximum to 500,000. I'm going to put a $10,000 benefit on here. Okay, I'm going to take the inflation out altogether. So this is going to give me a 4.17-year benefit, pretty close to 5-year. I've taken 50% assisted living, but remember, 50% of 10,000 is 5,000. That's still more than I had before, right? At 100% of 4,500. Policy maximum now is 500,000. Okay. So the fact that there's no inflation, my annual premium now, by the way, is less than how it was before. It's actually 6% less, and I think it's a better policy. So these are the old rates. These are the new rates. So you don't have to design something that costs $58.08. You can actually still charge them with the same premium and give them pretty much better benefits. So look at here. In 10 years, now it's paying $4,500. In 10 years, $6,000. In 20 years, $8,100. Then my benefit pool or pot of money starts at $270. 10 years, it's $363. 20 years, it's $488. Well, over here, I have $10,000 right at the get-go. And it stays all, there's no inflation. So 10,000, 10,000. So it's higher now in 10 years and in 20 years, and the pot of money is higher now in 10 years and 20 years. And this is less premium than it was before. Okay, so again, we don't just use the 3% compound anymore. All right, so here's another way to do the same one. So maybe your people aren't crazy about not having inflation. So maybe, we have what's called the buy-up in this product. So if you do start with at least some inflation, you can increase it later. So if you put 1% compound in this thing, lower the benefit back to $8,000 a month, I can then increase to 2%, 3% for any time prior to their 75th birthday, free of underwriting. So, some people just want to have that option and maybe increase it later. Okay, so I'm finding another way. So remember, the old rate's 48.52, new rate's 58.08. So another way to attack this, another way to crack the code, if you will, is I'm going to go 1% compound and do $8,000 benefit. Okay, my policy maximum, I'm going to put it $350,000. That premium now is about a net. It's about a wash. I mean, I got this as close to the old rates as I could. The old rates were 4,800, new rates 58. Doing it this way, my rate's 4,800, and look at the benefits. Now it starts at 8,000 instead of 4,500. $350,000 instead of $270,000. And in 10 and 20 years, it looks like about the 19th year I lose on the pot of money, but I'm still higher on the monthly amount. Again, I'm not as worried when people get into mid to later 80s because the claims are shorter lengths. So I'm okay with the pot of money running out. I still want that dollar amount to be there. So with 90% of claims not exceeding 2.5 years, I don't worry about years 4, 5, 6 as much. I want to make sure they got a solid amount covered in those first couple of years of their claim, because that's 80-90% of claims are the first 2 or 3 years. Okay, so one more way to do this, you'll kind of get the theme here. So here's another one. This is not, here I'm going to use 2% inflation. I'm going to put that amount at 5,500, and I'm going to put 75% assisted living. I'm going to put my policy max at 290,000 with 2%. So now again, I've netted those premiums out. So I've absorbed that rate increase, and my benefit payout here, 290, 253, 431. My monthly amounts, 55, 67, 81. So those are all netted out there. Again, average claim happens at 80, 81 for males, 80, 83 is for females. So, lots of ways to do this. So whether I wanted to use no inflation at 10,000, 8,000 and 1%, or 5,500 and 2%, all three of these ways took all the bite out of the long-term care refresh, they call it. So I've netted those premiums out pretty much every time. So the correct way to do this, again, don't use 3% anymore. Sell either no inflation or 1% with a higher monthly amount and a higher pot of money to begin with. All right, let's go on to our next. Okay, so this is now a married couple at age 60. If you recall, I'm just going to go up here and source again. So this is one where, again, this was 43% higher, right? So yeah, that's significant. Since that premium was 59, went up to 85.49. So all right. So again, premium was 59.65. Now it's 85.49. 43% higher. So again, we had agents calling us saying, man, Jeff, these rates went up 43%. I can't sell mutual anymore. I would say, wait, let me show you something. So again, first thing we're going to do is we're going to scrap the inflation and put it at 10 grand. We're going to move that pot of money up to 500,000, right? Take the inflation off completely, put the assisted living at 50%. Because remember, 50% of 10 grand is 5,000 a month. That's more than you had over here with 4,500 at 100%. Okay, this was 3%. So I'm taking the inflation out altogether, put my policy maximum at 500,000. So now my premium is 61.76, which is real close to what that 59.65 was. I've almost netted it out. And here's the benefits again. If you notice, the benefits are pretty equal. Matter of fact, the monthly amount's higher doing it this way for the next 25 years. Which again, I'm more concerned about this monthly amount than I am the total pot of money. You rarely get to $410,000, $430,000. It's pretty rare, if ever, you get to the end of your pot of money. What's more likely is that you're going to have these 1 year to 2 year claims. So I love having a shorter, fatter benefit, so that way they have a better chance to exit. Think of it like this. If someone wins the lottery, do you want to take a lump sum all up front, or do you want a lesser amount spread over 10 years? Most people are going to take that lump sum. Well, imagine if it wasn't even a lesser amount. Do you want it all up front, or you want to wait and have it be bled over 10 years? Well, everyone's going to take the money up front. Same in a long-term care claim. Why wouldn't you want all your premiums you paid in back as soon as you could get them, right? You want to get your money back out of insurance? Well, that's how you do it, is short and fat. If you do this long, skinny thing, they'll claim for 6 months at $100, $3,000 a month. They'll never get their money back out of it. So short and fast the way to go anyway. So this is what we've done here. So that 43% rate increase, I've got it down to just 2, marginal, nothing. Just by going 10 grand and no inflation. All right. Next example, same thing. You probably get the gist here. Now I'm going to split the difference. I'm going to go 1% inflation. I'm going to lower it. I'm going to move it to 7,500 instead of 10 grand. I'll move my policy maximum to 420. And again, by selling inflation at least 1%, this opens the door to this couple increasing that inflation to say 2%, 3%, 4%. Maybe they have competing expenses. They have kids in college. They have more money to spend on long-term care down the road. So it's not a bad idea then to go ahead and put the 1% compound there just to kind of open that door, if you will. So if I'm going to do that route, I'll just go 7,500. I'll go 420. And now this way it's 66.49. So not, it's obviously not the full 43% more. It's only about 10% higher. And again, my benefits down here, if you'll notice, they're going to be higher on that monthly amount, be higher on the overall pool of money until about year 20, somewhere in there. Again, I'm okay with that. All right. And if you're not, by the way, you can put this pot of money at 450 or something, and maybe it's 7,000. You still don't have to quite, you got a lot of room to play with there. So, and then the third example, again, this is using 2% inflation. Here I went 5,500, 2%, 75% assisted living, put my policy maximum at 350. So now, of course, that premium is about 22% higher, not the full 43%. I took some of the bite out of that rate increase, but these people really wanted to have inflation. So here again, the monthly benefits, 6,048 versus 67, 8127 versus 8170. Pot of money, pretty close here. A little higher. It's higher now, higher 10 years. Somewhere around year 18, 19, it crosses over there on the pot of money. So again, 3 ways to do it. I'm not sure which is the best one. If it's me, I might just do this no inflation thing. I'm kind of, the no inflation or 1%. The 1% gives you the ability then to, at least free of underwriting, increase your inflation without underwriting. So if someone's, sounds like it, I don't know, maybe dementia is starting to be an issue. They're worried about dementia, or they can't be on claim, but maybe the writing's on the wall. They can see a lot of care needs happening. They have the ability to go back in there and increase their benefits free of underwriting. It's kind of a nice option to keep that door open. So if I had to pick, I'm going no inflation or I'm going 1%. The 2% I threw in here just to show you there's more than one way to do this. The biggest thing is, remember, don't do 3% anymore. Okay. Last example is this one here at 47, and I'll go through this one pretty quick. I'm hoping you guys are understanding the gist of this. So this is a 55-year-old couple with a $162,000 benefit. Actually, I didn't use these exact benefits, but at 4,500, 6,200, 162 policy max, 90-day LM, 3% compound. That rate was 33.91. Now it's 49. So that went up 46%. Pretty stout. So let me find that one here. There you go. Okay, married couple, age 55. So again, premium was $33.91. New rate. By the way, if you notice in parentheses, 2013, as mad as a lot of brokers were about the fact that Mutual changed their rates, they hadn't changed their rates since 2013. I mean, so we had a pretty good run, some pretty good stability with how they price things. So, and with all the other carriers that are getting out of the market, I mean, we had over 110 companies selling long-term care 20 years ago. We're down to about 5, and you only broker about 4 of those or 3 of those. So, I'm glad that Mutual decided to stay in and adjusted how they're pricing things versus just to get out like the rest of them. So I applaud Mutual for staying in the business and gives us at least a way to kind of work around this. So, okay. So in this example, same thing here. I'm not going to bore you with the third example, kind of same thing. I'll go through kind of quickly. You will get sent a copy of this PowerPoint. And again, I urge you to call next time you have a case you're working on, you're just kind of playing around with the software a little bit. MutualLTCquote.com is where you can get that. Bring that up on your screen, get it downloaded, call me up. I have no problem spending 5-10 minutes with an agent quoting a case they're working on. That software is a great tutorial, a nice little way to kind of learn the product. So, okay. So, in this example, $33.91. So what I did over here then is I went ahead and just put a 10,000 instead of 4,500. I took the inflation out altogether. Policy maximum is $265,000 with no inflation. So this one here, this was a policy max of 162. So I started out about 100 grand higher than that. And so I guess here around year 20, the policy maximum exceeds. But look, it's not for 30 years. These people are 90 years old, or excuse me, 85 years old until that monthly amount catches. So remember, and I'll just say this again because I think it's more important, it's overlooked. This 55-year-old couple, they're not going to probably go and, we would assume they're not going to need care until they're 60s. But gosh forbid, if something happens at age 61, someone has a stroke or something, whatever it is, okay, early onset dementia. Well, now they're needing this policy a lot sooner than they thought. They're only getting paid, 4,500 or 5,000 a month from it. Versus if I started it with a higher amount to begin with, they're getting paid 10 grand. Because again, you take 4,500 to a nursing home, I don't know, anywhere in the country, that's only going to pay half the bill. Yeah, maybe 60. If you're in Shreveport, Louisiana or something, it's going to cover, maybe 80% of it. But the rest of the country here, it's going to be pretty tough, with 4,500 or 5,000 to cover anything. Okay, so at 10,000 and 265, 50% assisted living, my premium there, $33.99. So I've basically taken that rate increase out. Here's the same rates as we had back in 2013. Pretty much the same benefits. I know there's some give up later. And by the way, if I wanted to put that pot of money at 300,000, I could push those crossover points to 35 to 40 years. Okay, so I'm not as long. I wish we go more on the 10,000 here. That's the cap. But okay, so again, otherwise I can do this using 8,000 at 1%. Now here again, it's only about 11% higher, 3,700 instead of 3,391. Not that big of a deal. Certainly not 46% higher. So that takes a lot of bite out of the rate increase. And I've got benefits that are pretty comparable here all the way through. Okay. 10 years from now, 88, so that's higher. 8,000 is much higher than 4,500. 10 years, it's 88 versus 6,000. 20 years, it's 9,700 instead of 8,100. And finally, at year 30, it's right there, 10.9 versus 10.7 or 10.8. So again, I just this option on the right, much better way to design a plan. It's also a lot cheaper. They get a lot more bang for their buck by using the 2% or 1% and a higher amount. All right, kind of beat a dead dog here. And finally, that last one there is 5,500, 2%, 180,000. Again, this is only 26% of it. So again, as you get closer to that 3% compound, it's harder to save that money again or keep those rates down. So at the end of the day, and I had a formula here. Looks like it's not there anymore. I'm really taking it out. At the end of the day, I'll say this, to summarize it, to crack this code, to keep things affordable for your clients, use no or 1% inflation. Increase your maximum amount, your maximum policy max, increase your monthly maximum, and lower your assisted living a little bit, and lower that inflation down to, 0 or none. Don't be afraid to sell 10 grand with no inflation. $300,000 pot of money, no inflation. That inflation takes a long time to grow and to build. And I think if you're selling someone who's 52 years old, then you want to look at that 1 or 2%. So you have the ability to increase it later if inflation gets away from us. If we keep seeing inflation the way it is out there right now, I get a little worried. But that's that. Selling at least 1% gives them the ability to add it to 2, 3, 4, or 5 anytime they want without underwriting. So my suggestion: you want to keep premiums down. You want to be able to give design plans with more bang for your buck for your clients. Use no inflation or 1% inflation. And you're going to get a copy of this presentation here. So I also know, we have a chance to win a $100 Amazon gift card just by scanning this code. It downloads basically our contact information into so you have access to all of our tools, our different things, our website, our agent tools. So this will be coming out. Lynn will send a copy of this out to everyone, this PowerPoint. So when you get that, if you want to scan that, I'll leave this on the screen here for a little bit. If you want to scan that code, the QR code, it puts you in a drawing. I know we draw every week, I believe, for a $100 gift card. So I've given out a couple of my guys already. I know, I think we've already done 5 or 6 of these. We draw every week. So if you haven't already, scan that code, and you might win $100. So all that's doing is just putting GoldenCare's contact stuff where it's easy to get. If you have a smartphone, it puts an app on your phone that you press it. It's going to give you all like the GoldenCare tools, contact information, just easier access to us. So kind of a neat thing, I guess. Other than that, I'm going to go back to this 800 number. I encourage you to call us. I got to take this call. Call us when you can, 800-842-7799, and you have a case you're working on. But that's all I really have for you guys today. I'm going to see what we have for questions quick here, if there's any that I can maybe answer. Let's see what we got here. Yep, All right, no questions or comments. That's good. That either means I either completely confuse you folks or you're understanding it. So again, if you're not, next time you're quoting a case, if you want to get more bang for your buck, you want to crack the code, call up the marketers here. GoldenCare will help you out. 800-842-7799 is our number. Want to thank you sincerely for spending the half hour with us. Good luck selling out there, and hopefully we'll talk to you soon. Thanks.
Check out our website, goldencareagent.com, or give us a call at 800-842-7799.